All right, settle in. We are back with another deep dive.
It's good to be back.
Today, we are stripping away the noise and looking directly at, well, the machinery of the market. If you are here for surface-level headlines or, the kind of analysis that fits in a tweet, you might want to check the exit.
Yeah, this isn't that.
But if you are looking to understand what is actually moving the needle in your portfolio, specifically in the energy sector, you are home. This is Talk Tickers, and we are broadcasting for the buy-side mindset.
And honestly, the timing for this one couldn't be better. The market is giving us a really fascinating puzzle today.
Today is Saturday, February 14th, 2026. Happy Valentine's Day to those who celebrate, and happy Earnings Digest Day to the rest of us.
Nothing says romance quite like analyzing the spot price of uranium and digging through MD&A reports.
Exactly. Roses are red, violets are blue. I'm long uranium. How about you? Speaking of uranium, we have a monster on the slab today, Cameco Corporation.
The big one.
Ticker CCJ. The undisputed heavyweight champion of the Western nuclear fuel cycle just dropped their Q4 and full year 2025 numbers. And let me tell you, the market reaction was, well, let's call it complex.
Complex is a very polite way to put it. It was a classic setup, almost textbook, but the reaction, it really requires a second, third, and maybe a fourth look to really get what's happening under the hood.
Okay, let's hit the vibe check right out of the gate. We are looking at a close yesterday around, $112.90?
Yeah, just under 113.
The stock was down roughly 3% on the day. Now, normally, if I tell you a stock is down 3% after earnings in a bull market,
yeah,
and let's be clear, we are in a bull market, you assume they missed.
You assume a big miss. Or a guidance catastrophe.
Right. You assume they guided down disastrously. But here's the kicker. They beat on the top line. They beat on the bottom line. Yeah. And yet the chart looks like a staircase going down to the basement.
What is the disconnect here? It is the oldest story in the book for resource stocks, but with a very specific twist for this cycle. This was a sell the news event, but more specifically, it was a sell the optics event.
So the optics, I like that. Unpack it.
The market. And by the market, I mean the algorithms, and frankly, the tourists who just arrived for the momentum trade. They were looking for one thing, a massive volume ramp.
They wanted more pounds.
They wanted Cameco to come out and say, we are opening the floodgates, production is soaring, we are drowning the world in yellow cake. Instead, management came out and said, we are disciplined.
We are patient.
We are patient, we are not flooding the market, and the hot money just ran for the hills.
Right. It's the friction between what the street wants, which is, immediate gratification and volume growth, and what the company's actually doing, which is value preservation.
Precisely. If you just skim the headline guidance for 2026, it looks flat, maybe even a little soft on the production side. But if you actually listen to what Grant Isaac and Tim Getzel said on the call, the thesis hasn't changed. If anything, it has actually strengthened. They are playing a high-stakes game of chicken with the utilities, and they are absolutely refusing to blink.
I love a good game of chicken, especially when my portfolio is on one side of it. So here's the roadmap for this deep dive. We are going to unpack those headline beats because the quality of those earnings really matters.
It does.
We're going to tear apart this discipline versus production narrative, especially regarding MacArthur River, because there is some serious drama there with the geology. We're talking clay zones, freeze walls, the works.
It's a fascinating engineering story in its own right.
It really is. Then we need to talk about Westinghouse, why it looks lumpy on the balance sheet, and why the CEO literally skipped his own earnings Q&A to fly to Washington, D.C.
That is the signal. If you take one thing away from this, it's that. That is the alpha.
A huge signal. And finally, we're going to look at the options market because while the stock was down, the call volume was, it was absolutely exploding. Somebody knows something.
Or at least they're betting like they do.
Exactly. And of course, stick around for the end because we have a speculative trade of the week scenario, that is. Well, it's spicy.
It is certainly creative. Let's put it that way.
Disclaimer time first. This is not financial advice. We are two voices in your headphones analyzing public data and doing some hedge fund role play. Do your own diligence. Don't sue us. Now, let's get into the numbers.
Let's do it.
The headline snapshot. Adjusted EPS. Where did they land?
They came in at $C$1.50, so 50 cents Canadian.
50 cents. And the street consensus was sitting around what, $C$1.45?
Yeah, that's right. The consensus was about 45 cents, so that is a solid beat.
A 5-cent beat on an adjusted basis is nothing to sneeze at. That is operational efficiency kicking in. But we should probably clarify what adjusted means here because people get suspicious of that word,
They do, and they should. In this case, though, it's pretty clean. They are mostly stripping out the noise from the mark-to-market accounting on their financial derivatives and some reclamation adjustments.
So this isn't some earnings before all the bad stuff calculation.
No, not at all. This is a legitimate view of the operating cash flow. It's a good number.
Okay, good distinction. Revenue, then. Top line.
Revenue clocked in at 1.2 billion Canadian, and that beat the consensus of about 1.09 billion.
So pretty significant beat there, too. Over $100 million more than expected.
It's a huge beat. They sold more and they made more per share than the smart guys on Wall Street predicted. It was, by all headline metrics, a blowout quarter.
And the full year.
Full year 2025 adjusted net earnings were $627 million. And the big one, adjusted EBITDA, came in at nearly $2 billion, $1.93 billion to be exact.
And that EBITDA number is crucial, isn't it? Mm-hmm. Because it speaks to the underlying health of the business.
It's everything. Almost $2 billion in EBITDA shows the cash-generating power of this integrated model. You have to remember, they aren't just digging rock anymore. They are refining, converting, fabricating fuel, and managing a massive global industrial services business in Westinghouse. It's an industrial giant now, not just a mining play.
That's a great point. When you look at the multiples, people still treat it like a pure play miner. But with that kind of EBITDA stability, it's starting to look a lot more like an industrial utility itself.
And that's the re-rating story that I think a lot of people are still missing. The market hasn't caught up to what Cameco has become.
Okay, let's look at the operational metrics, the actual pounds. 2025 uranium production.
21 million pounds, that's the Cameco share. And that met their revised guidance.
They did what they said they would do.
Which is so important for credibility in this sector. In mining, doing what you say you will do is, frankly, rare. Usually a whole truck breaks, there's a tire shortage, the grade isn't what you thought, some goes wrong.
Always something.
Always. Cameco, hitting that number on the nose, says their operations team is dialed in, regardless of what the geology is throwing at them, and we'll get to what it's throwing at them later.
Yes, we will. Average realized price for those pounds.
$62.11 US.
Okay, US 62.11. And that's a blend, right? People see the spot price at 80 or 90 and wonder why the realized price is lower.
Exactly. You have to remember, their realized price is a blend of all their contracts. It's climbing steadily as those older, cheaper contracts from the bear market roll off and the new higher price contracts kick in.
So it's a lagging indicator.
It's a lagging indicator, but the trend line is powerfully up and to the right. Every single quarter, that realized price ticks up, which means every pound they sell is becoming more profitable without them having to dig any faster. It's pure margin expansion.
And the long-term book looks solid. They're committed to deliver about 230 million pounds.
Yeah, and that averages out to about 28 million pounds a year for the next 5 years. So they have a very full order book. There's no demand problem here.
Okay, so let's circle back. Everything sounds great. Beat on revenue, beat on earnings, met production guidance, realized prices are climbing. Why then did the stock dip 3%? Why the long faces on the trading floor?
It all comes down to the future. It's the 2026 outlook. The market is a forward-looking discounting machine, right? It doesn't care about 2025 anymore. That's ancient history.
It's in the price.
It's in the price. So they looked at the 2026 production guide, and what did they see? 19.5 to 21.5 million pounds.
Which is essentially flat.
It is flat to potentially down from where the bulls wanted it. I mean, the market expectation, the whisper number, was that MacArthur River, their flagship mine, would be ramping up faster.
They wanted to see a clear path to that 25 million pound license capacity.
Exactly. And seeing a guide of, let's call it 20 million pounds, signals constraints.
Yeah.
It signals that the supply response isn't coming as fast as people thought, or more accurately, that Cameco is choosing not to bring it.
Okay, so that's Frichter point number one, the production guide. What was number two?
Number two was the Westinghouse guidance. The adjusted EBITDA for Westinghouse in 2026 is guided at 370 to 430 million US dollars.
Which is down from 2025 levels.
Right. And if you are an algorithm reading a press release, you see EBITDA guidance down and you You hit the sell button immediately, no questions asked.
But the context is everything here.
Context is the entire game. 2025 had a massive one-off payment in it. It was related to the Dukovany project in the Czech Republic.
Right, Dukovany. That's the big new build-out they're involved in over there.
Exactly. That payment was about $170 million of pure benefit that happened once. It's not repeating in 2026. If you strip that one-time payment out, the core business is actually growing quite nicely.
But the headline number looks lower.
And the algorithms don't know how to adjust for lumpy payments in the nuclear new build industry, so they sold the headline. It was a classic case of the machines not understanding the story.
So we have a flat production guide and a headline drop in Westinghouse EBITDA. I can see why the knee-jerk reaction was negative. But let's peel back the layers here. Let's talk about this discipline thesis. Because Grant Isaac, the CFO, well, technically president and COO now, he was on fire during the call about this.
He was.
He didn't sound apologetic at all. He sounded defiant.
He was. And this is the core conflict of the Stark right now. Grant's argument is essentially this. The entire industry contracting in 2025 was only 116 million pounds.
Okay. Is that a lot? Put that in context for us. What does the world actually burn in a year?
No, it is incredibly low. The world consumes much more than that. We're talking closer to 180, maybe 190 million pounds annually.
So there's a huge deficit.
A massive deficit. Utilities are burning fuel way faster than they are contracting to replace it. They're drawing down their inventories. So Grant's view, which he laid out very clearly, is why on earth would we ramp up production to 100% capacity if the customers aren't signing long-term contracts to support it?
He actually said, "We will not front-run demand." I wrote that quote down.
Exactly. It's a complete refusal to flood the market. In the past, uranium miners, Cameco included, would see the price tick up and they'd immediately start digging as much as they could.
And what would happen?
They'd flood the market, crash the price, and kill their own margins. It was a race to the bottom. This is a new Cameco. A completely different philosophy. They are saying, we are starving the market.
It's a siege. They're laying siege to the utilities.
It is. They are saying to the utilities, you want the pounds? Fine, you sign the contract. And you sign it at our terms, with our duration and our price floors. Until you do that, the uranium stays in the ground. It's basically a strike. The miners are on strike against the utilities until the price reflects the true scarcity.
This reminds me of that quote about discipline is choosing what you want most over what you want now. The market wants volume now. Cameco wants higher prices and better terms later.
And they are using the geology of their own mine to their advantage here. It's brilliant, really. Let's talk about MacArthur River.
Yeah, let's get into the dirt.
Yeah.
Literally. The MD&A mentioned technical risks. They talked about encountering clay zones. This sounds bad. Clay in mine usually means instability, water issues, delays. For the listener who isn't a geologist, why is clay such a problem at MacArthur River specifically?
Okay, so to understand this, you need a quick picture of the mine. MacArthur River is the highest grade uranium mine in the world. It's unbelievably rich, but it's also wet. The ore body is located in this very porous sandstone formation that is saturated with high-pressure water.
So if you just dug a tunnel into it?
The mine would flood instantly,
Yeah.
catastrophically. It's a huge engineering challenge.
That sounds terrifying.
It is. So to mine it safely, they use a technique called a freeze wall. They literally drill a series of pipes around the ore body and pump a supercooled brine solution through them to freeze the ground solid. They create a massive, impermeable ice barrier.
So they're mining inside a giant ice cube, basically.
That's a perfect analogy. They mine inside the ice cube where it's safe and dry. It's an incredible feat of engineering.
Okay, so where does the clay come in? Why does that mess things up?
Well, clay doesn't freeze the same way that uniform sandstone does. It's less permeable, it insulates, it can shift and heave. When they started drilling for the freeze wall in new areas, they encountered these unexpected clay zones. It slowed down the freeze wall installation.
So it takes longer to get the ground frozen solid and stable enough to mine.
Exactly. It's not a showstopper. It doesn't mean the uranium is gone, but the development is slower and more methodical than they'd planned.
So is the mine broken? Is that the risk?
No, the mine isn't broken at all. The ore is still there, but the pace of development is constrained. Now, here is the strategic brilliance, or, the convenient excuse, depending on how cynical you want to be.
I'm feeling cynical today.
Grant Isaac basically said on the call, look, we encountered these geological issues. We could spend a fortune to accelerate through them. We could do heroic engineering to catch up and try to hit that 25 million pound per year license capacity.
They could just throw money at the problem.
Right. But his question was why? Why would we spend the money to rush pounds to the surface when the global contracting level is only 116 million pounds?
When the customers aren't even covering their own replacement rate.
Exactly. So they're accepting the delay. They are saying, we will let the geology dictate the pace because the market isn't giving us an incentive to speed up.
So the technical risk is actually a tool for supply discipline.
It aligns perfectly. It is the perfect cover story. It removes the temptation to overproduce. They can point to the clay zones and say, sorry, can't dig faster, while secretly high-fiving in the boardroom because it keeps the spot market tight.
They're turning a bug into a feature.
100%. It allows them to maintain that discipline narrative while also addressing what is a legitimate engineering constraint. They get to be both prudent operators and shrewd market strategists at the same time.
Speaking of the spot market, let's look at how they are filling the gap in their delivery commitments. They guided to deliver, 29 to 32 million pounds in 2026? That's right, 29 to 32 million pounds.
But they are only producing, let's call it 20 million to be generous. That is a 9 to 12 million pound deficit. Where's that coming from?
Inventory and purchases. That's the other key part of this. They explicitly stated in the guidance they will purchase up to 3 million pounds in the spot market or from their joint venture at Inkai to meet those delivery commitments.
This is significant. You need to pause on this point. The largest uranium producer in the Western world is a net buyer in the spot market.
It completely changes the market dynamics. It supports the price floor. Instead of digging it out of their own ground, depleting their own tier one assets at what they believe are still discounted prices, they are going into the open market.
They're taking pounds out of circulation.
Exactly. Taking pounds out of circulation and handing them directly to their utility customers. It tightens the secondary market. It creates a physical squeeze. It sends a message to every hedge fund and trader out there.
What's the message? The message is, if you're thinking of shorting this market, or if you're a utility hoping to buy cheap pounds on the spot market, you're not just competing against other traders. You are competing against us, Cameco. And we have deeper pockets than you do.
It feels like they are acting more like a central bank of uranium than a miner. They are managing the float. They're conducting open market operations.
That is a great analogy. They are managing the liquidity of the uranium market, and right now their policy is quantitative tightening. They are shrinking the available supply. Good luck fighting that.
Okay, let's pivot. Let's pivot to the other side of the business. The side that caused the EBITDA miss, panic, but just might, hold the biggest key to the future.
Westinghouse, the growth engine.
We mentioned the EBITDA drop due to that one-time Jacobini payment rolling off. But there is a much, much bigger story here. And it starts with the CEO, Tim Getzel.
Yes, it does.
He recorded his opening remarks, and then he left. He did not stay for the Q&A session with the analysts.
Which is highly unusual. I mean, in the world of corporate governance, it's almost unheard of, unless there is a major crisis or a truly massive opportunity brewing. Usually the CEO is there to defend the numbers, especially when the stock is reacting negatively.
He was on a plane. He was on a plane to Washington, D.C. to meet with the Department of Energy. You don't blow off your own earnings call Q&A unless that meeting is monumentally important.
This is all about the DC connection. We've known about the strategic partnership with Brookfield, Westinghouse, and the U.S. government. We have heard the number $80 billion thrown around.
80 billion with a B. Okay. It's a number so big it almost sounds fake.
It is. That is the cited investment value for deploying a fleet of Westinghouse AP1000 reactors across the United States and allied nations. What Getzel is chasing in D.C. is the definitive agreement on this. The term sheet is signed, but they need to lock in the details, the funding, the timeline.
And this connects directly to the Trump executive order, right? The mandate to have 10 gigawatt scale reactors under construction by 2030.
Correct. And this is where the lumpiness that the market hates actually gets very, very interesting.
Okay, explain.
Normally, building a nuclear reactor follows a very boring, linear, and slow path. You do a FEED study, that's front-end engineering design, then you do more engineering, then you pick a site, you get permits. Then, finally, years and years later, you order the equipment.
The long lead items, the big ticket stuff.
Right. The reactor vessel, the steam generators, the coolant pumps, the really big stuff that takes years to forge and manufacture. But to meet this 2030 deadline from the executive order, that traditional timeline doesn't work. It's simply too slow.
You can't get 10 plants started that way.
No chance. So what Grant Isaac hinted at, and this is the real alpha from the call, is that they are working to separate the site selection process from the long lead item ordering process.
Yeah, explain that. How does that work? They're going to order the parts before they even know where the plant is going to be built.
That is the implication. To hit the deadline, the U.S. government or this new public-private consortium might place a bulk order for, say, 10 reactors worth of heavy equipment in 2026 or 2027.
A bulk order. Like going to Costco for nuclear reactors. Yeah, I'll take a pallet of AP1000s, please.
That's pretty much it. I'll take the 10-pack, please. If that happens, you get a massive, massive spike in procurement revenue for Westinghouse before the utilities have even finalized the dirt work on the sites.
That completely reverses the traditional cash flow model.
It flips it on its head. It brings cash forward by 3, 4, maybe 5 years. And that potential revenue
is not in the 2026 guidance.
It is absolutely not in the guidance. The guidance for Westinghouse that we saw, the one the market sold off on, that assumes the traditional slow rollout. If they sign a deal for long lead items for 10 reactors, the revenue numbers we are looking at today are a joke. They are completely and utterly irrelevant.
That explains the lumpiness comment from management, and it also explains why Tim Getzel is in the sea. If you are negotiating an $80 billion framework that involves pre-ordering massive national infrastructure, you want to be in the room.
You have to be in the room. You don't want to be on an earnings call answering analyst questions about clay formations in Saskatchewan. You send your COO to do that.
And that is why the smart money, the ones buying those calls, they might be looking past the 2026 EBITDA guide. They are looking at the potential for a procurement supercycle starting late this year or early next.
It's fascinating. It's basically government-backed vendor financing on a massive scale. It's the only way to reindustrialize the U.S. energy grid on that timeline.
And Westinghouse is the only game in town for it.
In the West, for a licensed, operating, proven Gen 3 plus reactor, yes. They aren't betting on science projects. They are betting on the AP1000. It works. You can order it today.
Let's talk about the other parts of the business that often get overlooked. Fuel services. Everyone talks about the mining, but the conversion business is, from what I understand, printing money right now.
It is, fuel services, and specifically conversion, which is the process of turning the uranium powder, the yellow cake, into a gas so it can be enriched. Prices are at historic highs.
Why is that?
It's a massive bottleneck,
Oh.
even tighter than the uranium mining side. And here, Cameco is playing the exact same discipline card they're playing with the mining.
Grant had a great quote about this on the call. He said, "You only get one chance to sell new capacity."
That is the mantra for the whole company right now. Think about it from their perspective. If you sign a new conversion contract today at these record high prices, but you only sign it for 3 years, you're taking a huge risk.
A risk that in 3 years the bottleneck eases up and prices have crashed back down.
Precisely. You've wasted the opportunity. Cameco saying, no, we don't just want price, we want tenor.
They want duration.
They want 10 to 15 years. They want to lock in these record high margins for a decade and a half. They're telling customers, if you want our conversion capacity, which is the only reliable large-scale Western capacity, you are going to marry us. This isn't a date.
And since they own the key capacity in North America at their Port Hope facility, the utilities don't have much choice, do they?
They don't. The Russian capacity is politically toxic and effectively sanctioned for Western utilities. The French capacity is fully booked, serving Europe. For North American reactors, Cameco holds all the cards. It's a monopoly in everything but name.
Then there is the really futuristic part of the portfolio, GLE. Global Laser Enrichment. This feels like the sci-fi component.
It is the tech play. And they had a huge update in this report. They officially achieved TRL6.
TRL6. What does that mean in plain English?
TRL stands for Technology Readiness Level. It's a scale NASA uses. TRL6 means they have a working prototype operating in a relevant environment. For GLE, it means they confirmed 99.6% purity from their laser process. The science works. It is no longer a theory. It is a proven process.
So what is the business model here? Is it just a better, cheaper way to enrich uranium?
It's much cooler than that. The primary business model is tails re-enrichment. This is the genius part. The U.S. Department of Energy has massive stockpiles of depleted uranium, they're called tails, from decades of old, inefficient enrichment. They're sitting in thousands of cylinders in Kentucky and Ohio.
And it's basically considered hazardous waste, right? It's a liability.
It's a huge liability on the government's books. They have to pay to guard it and maintain it forever. But GLE's laser technology is so precise, it can take that waste, zap it with lasers, and extract the remaining U-235 isotopes that the old brute force centrifuge technology missed.
So they're literally turning government garbage into nuclear fuel.
Yeah. Precisely. It turns a multi-billion-dollar government liability into a 4 to 5 million pound per year uranium mine that sits above ground in Kentucky. There is no geological risk, no clay zones, no water inflow. It's just an engineering and manufacturing problem now.
And the feedstock is free or even negative cost.
Likely negative cost. The DOE would probably pay them to take the tails away and process them. It effectively creates a massive, low-cost domestic uranium mine right in the U.S., which perfectly aligns with all the national energy security goals.
So moving from TRL-6 to TRL-7, 8, and 9, that's just scaling up to a commercial facility?
That's the next step. It's not a small step, but the fundamental science risk has been taken off the table with this update. It is the hidden jewel in this portfolio that I am convinced nobody is pricing in yet.
Okay, so we have the discipline in mining creating a price squeeze. We have the explosive, lumpy potential in Westinghouse with the U.S. government. And we have this incredible tech upside in GLE. Let's bring this all back to the investor. The stock's down 3% yesterday, but we saw something very weird in the derivatives market.
We did. It was a blinking red light.
We saw a massive spike in options activity. The number I saw was 384,705 call contracts traded on the day of earnings.
It's a staggering number. To put that in perspective, that is a 1,490% increase over the typical daily call volume.
Nearly 1,500%. That is not retail traders on Reddit buying a few calls.
Yeah.
That is institutional volume. That's a whale.
That is whale activity. While the equity itself traded down, likely due to the algorithms and the fast money guys reacting to the flat guidance, someone with a massive amount of capital stepped in and bought calls aggressively, hand over fist.
What's the read there? What are the possibilities?
Two main possibilities, I think. One, the simple one, is they see the sell the news dip as a massive buying opportunity. They understand the discipline story, they've done the work, and they're positioning for the inevitable bounce.
And the second, more conspiratorial possibility.
The second is that they are front-running a specific announcement regarding the U.S. government deal. If you have some insight, some channel check that says Tim Getzel is in D.C. to finalize the $80 billion package, and you see the stock just dipped 3% on a misunderstanding of the guidance, what do?
You load the boat. You buy as many out-of-the-money calls as you can get your hands on.
Because the asymmetry is incredible. The downside is the premium you paid. The upside is a multi-bagger if that headline hits.
It feels like a coiled spring. Before we get to the trade idea, we need to talk about one more concept, the wedge.
The uncovered requirements wedge. This is the chart that should keep utility executives up at night.
Explain it.
It's simple. It's the growing gap between what utilities need to burn in their reactors every year to keep the lights on and what they've actually bought under long-term contracts. And that wedge, that gap, is getting wider and wider.
Because they're delaying. They're hoping the price comes down.
They're kicking the can down the road. But Cameco, with their disciplined strategy, is refusing to produce more until they sign. So the wedge just gets bigger and bigger.
And the bigger the wedge gets,
the more violent the eventual price spike will be when they are all first to buy at the same time. It's simple supply and demand physics. Eventually, the utilities run out of fuel they have to buy. And if Cameco hasn't ramped up production by then, there is no supply. Price goes vertical.
It's a slow-motion squeeze play.
Exactly. And the longer the utilities wait, the more painful it will be for them, and the more profitable it will be for Cameco in the long run.
All right. We have analyzed the past, we have dissected the present. Now it is time to look into the future with our favorite segment.
Let's do it. Time to play pretend.
This is the part of the show where we turn off the analyst brains and turn on the hedge fund cowboy brains. This is strictly for entertainment purposes. Do not trade on this. We are role-playing. But if we were sitting in an investment committee meeting right now, pitching a high-risk, high-reward idea based on all this data, what would it be?
I'm calling this trade the lumpy EEP spread.
The lumpy EEP spread. I like it already. It's got a nice ring to it. Break it down for me.
Okay, here's the setup. The thesis is based on one core idea. The market hates lumpiness. They penalize the stock because the Westinghouse earnings aren't a smooth, straight line up. They want predictability.
We want utility-like earnings.
Exactly. But we know the U.S. government's $80 billion injection is imminent. And that is the definition of lumpio. It's a giant, unpredictable lump of cash that is going to hit the books all at once. So we're going to bet against the market's obsession with smoothness.
So we fade the market's short-termism. How do we structure it?
Leg one, you go long, You buy deep, out-of-the-money LPs, and I'm talking far out, January 2027 or maybe even January 2028 call options on CCJ.
Why so far out in time?
Because you are not betting on next quarter. You are betting on the long lead item bulk order. You are betting that the Trump executive order forces the DOE to write a massive check for 10 reactors worth of parts sometime in late 2026 or early 2027.
Which, as we established, is not in the current guidance.
Not even close. When that headline hits the wire, Westinghouse secures multi-billion-dollar order for 10 AP1000 reactors. The stock doesn't go up 5%. The stock re-rates instantly and violently. You want to own the long-dated optionality on that specific re-rating event.
Okay, so we are buying the 2027 or 2028 calls, but those are going to be expensive, right? Options are priced on volatility, and implied volatility is elevated after an earnings event. How do we pay for it?
That is leg two, the hedge, or really the financing. You sell short-term, slightly out-of-the-money puts.
So you're selling the elevated volatility to the nervous Nellies.
Precisely. The stock just dipped. Implied volatility is juicy. You sell puts at a strike price where you'd be comfortable owning the stock anyway. Let's say the $105 or $108 level. That's a key support zone on the chart.
So let's walk through the scenarios. If the stock stays flat or goes up in the near term.
The puts you sold expire worthless. You keep the premium, and you use that cash to dramatically lower the cost basis of your long-dated LEA calls.
And if the stock drifts down in the short term to, say, 105.
You get assigned. You are forced to buy the stock at $105 a share.
Which, given the entire fundamental thesis we just spent an hour discussing, you should be perfectly happy to do.
You should be thrilled to do. You are happy to own the stock at that support level if the disciplined strategy bores the market for another few quarters. You are essentially getting paid to wait for the Westinghouse explosion.
Okay, and what's the outrageous kicker? The part that makes this a grand slam instead of a base hit.
The kicker is that if the DOE announces the full 10-reactor package, this isn't a 20 or 30% trade. This is a multi-bagger on the LOP. You are effectively buying the world-class uranium business for a fair price, and you are getting the world's largest construction project, the complete renuclearization of the United States energy grid, for free.
You're buying the mining business and getting a free call option on the U.S. energy transition.
That is the trade in a nutshell. The market is focused on the uranium. The real value might be hidden inside the Westinghouse acquisition that everyone is still trying to figure out.
I love it. It's a trade on patience versus impatience, on substance versus optics. All right, let's wrap this up. Recap this whole thing for the listeners.
Okay. Cameco beat the numbers on the top and bottom line. The tourists and the algos sold it because they didn't see the massive production ramp they wanted.
But the pros, or at least the people listening to this, know that discipline creates far more value than volume in a tight commodity market.
Exactly. They are choosing price and terms over volume. They are starving the market to force the utilities to the table to sign long-term, high-margin contracts.
And Westinghouse is the massive wild card. The CEO is in Washington. The government's checkbook is opening up. The lumpiness that the market sold is actually a feature, not a bug, because it means a giant catalyst is on the horizon. That's, to me, Tim Getzel flying to D.C. while his own earnings call is happening is the ultimate tell. That one action tells you everything you need to know about where the real growth is coming from. Yeah. It's not coming from digging more rock at MacArthur River right now. It's coming from the stroke of a pen in a government office.
Follow the CEO, not the stock ticker.
Keep your eyes on the spread, and we'll see you on the next tick.
Signing off.
This has been Talk Tickers. Over and out.